Well, welcome back to the Financial Times. I'm joined now by Alex Wynaendts, Chief Executive of Aegon. So life insurers on both sides of the Atlantic have been grappling with low interest rates for months and years.
Yes.
Just how big a challenge is this for the industry at the moment?
Well, it clearly is well known that for the insurance industry, in particular the life insurance industry, low interest rate environment has never been really supportive. It makes it more difficult to manufacture and sell products that make sense for customers. Well, they also have to make sense for the life insurance companies. And what you see is that therefore you see quite a lot of shifting from products that are very much interest rate sensitive to products that are much less interest rate sensitive. We've been doing that quite aggressively in the UK, in the US, more particular. As you know, universal life, these products have been in many cases discontinued. We have had to reprice products, but also bring new products to the shelf, term insurance, term life. So there's been a shift in products away from these interest rate sensitive products. And that you will see to continue for as long as rates stay where they are.
But it's still a big problem, isn't it, for the products written in years gone by, which have got years, decades more to run. I mean, how much longer can the industry put up with low interest rates, given the problem on the so-called back books?
Yeah, it's absolutely true that many of the products in the past have been sold on the basis of interest rates that were higher than what they are today. However, for Aegon, we are fortunate in the sense that we've put in place very strict asset liability management, which means that those liabilities of the past, we have been able to match them with bonds that had higher coupons. And obviously, what you see happening is that after some time you have to reinvest money, and it's the reinvestment risk which is the one that is affecting the health of the companies. So for Aegon, that is a small part of our total portfolio, and that means that we can withstand this environment for some time. In other markets in Europe, where you've seen higher guarantees which were not always supported by a portfolio of assets that also had the higher interest rate guarantees, that is now becoming an issue, absolutely.
And an issue in what sense? I mean, how is that manifesting itself, and how big a headache is it for some markets, particularly in Germany, for example?
Well, it can become a headache when you're making promises to your customers that are impossible actually to make up with the level of interest rates you hire. So that depends very much on the sector, of the type of products, but it's clear that the longer the situation lasts, the bigger the problem becomes.
And as you've mentioned, you know, insurers' assets the portfolios are still dominated very much by investment-grade corporates and government bonds. I mean, how tempting is it at the moment to be looking at some of this higher-yielding type asset classes?
Well, it's always about finding the right balance. We have a large portfolio. We want to make sure that we have a high-quality portfolio, because our portfolio backs up promises we make to our customers. So you cannot go to levels which are not anymore investment grade for bigger parts of your portfolio. You could do that for a very small part, you could diversify, but that is not, I don't think that is a solution. You have to stick to a strategy of having a high quality portfolio, because that's what's backing up the promises you're making to your customers.
And just turning to regulation, the European regulator has unveiled plans to shake up the so-called Solvency II regime to get it off the ground finally. How confident are you that there is going to be a deal found here? And is the industry willing to make concessions to get the thing finally agreed?
It's very difficult to say how confident we are. There are many stakeholders which are involved. I think there is a dialogue which is now being more constructive than it's ever been. It's clear there have now been proposals made by EIOPA to the industry. We've been clear that these proposals, although they go somewhere in the right direction, they are not sufficient. They're not sufficient to deal with all the outstanding issues. And we hope that in the coming weeks and months we are able to get progress, because if we cannot come to a solution in the next 6 months, then the whole process risks to be significantly delayed because of the European the Parliament elections.
Possibly a possibility that it's obviously, you know, not a deal now may essentially never be implemented in the way it's envisaged across Europe. Is that, I mean, how big a risk is that?
It's very difficult to say what the risk is, but what is important is that we have a right solution. We as an industry cannot work with a solution which is not the right one for the industry, one that is predictable, because we have to manage our risk, we have to manage our assets and liability, and therefore we need to have the right solution and a predictable solution.